On my furthest left is Sarah Wilson, who's the founder and managing director of Manifest, the UK's independent corporate governance and electronic proxy voting service. To my immediate left is James Thorne, who's a small cap fund manager at Threadneedle and is responsible for the Retail Smaller Companies Fund. And on my right is Stephen Haddrill, who is Chief Executive of the Financial Reporting Council. I'm going to open the panel discussion with a few remarks, and then the panellists will chip in, and there will be plenty of time for questions from the audience. I was, as Tim said recently, the chairman of the QCA's Corporate Governance Committee, and recently stood down, and the fact that there's been a deluge of consultations from organisations I'd barely heard of, as well as ones like the FRC that I know well, is coincidental in my decision to step down. But I think it's true to say that there has been an overwhelming volume of consultations in the recent past. And I was thinking today, firstly, if the Corporate Governance Committee of the QCA at times felt it was barely able to cope with a legion of unpaid but very skilled volunteers to that committee, together with the hard-working executives at the QCA itself, what must it be like for member companies of the QCA hoping to keep up to speed with all this, but far more importantly, non-members of the QCA. It really is an enormous volume of work just to keep tabs on, let alone to try to influence. And I think in amongst all of these consultations, I think it's really important that we don't lose sight of the purpose of governance, because sometimes there can be huge discussion and debate on minutiae, but actually we should step back for a moment and think about why are we doing all this, and I think the QCA Corporate Governance Guidelines has a good stab at trying to remind its readers of the purpose. And I'll just read out what we said in our introduction, that really corporate governance is a code of behaviour, and I'll emphasise the word behaviour, expressing how management teams in companies act and are organised both to create and to protect value. And again, I'll emphasise the word value on behalf of shareholders. And I really just want to talk a little bit about codes of behaviour and a little bit about value before I hand over to my other panellists. And I was thinking about codes of behaviour beforehand, and really thought about the 10 Commandments as the earliest one that I could think of. I'm sure that there are probably others in prehistory, but there's been endless debate really on codes of behaviour from the Tens of Commandment onwards, and the minutiae and what they mean and how to interpret, and actually what is the purpose of what that code is trying to achieve sometimes gets lost in those debates. And actually, with all that noise occurring around the discussions, we forget that actually what is fundamental is the board has to make a judgment as to what it thinks is best, and it has to ideally enter into a dialogue with its owners, with its shareholders, onto what it thinks is best. And actually it's that dialogue and debate, direct conversation and disclosure that actually we believe at Hermes, and certainly the QCA strongly believes it, actually drives better decision making, both on behalf of investors and on behalf of boards themselves, through that interaction, discussion, debate. So I think we sometimes need to remind ourselves that the most important thing is that dialogue between the two most important parties in corporate life, the owners and their agents. And much of the rest of the debate, important as it is often noise, confusing, and difficult. And I would add that trying constantly to refine, whilst again probably important to improve the terms of engagement, can actually be subject to a law of unintended consequences. And this morning I was listening to the continuing debate on Jimmy Carr's tax affairs, and actually was beginning to think, you know, that the spirit of the law is being forgotten in much of the debate, and actually it's all about the mechanics of the law, and actually what feels wrong and what feels right after debate and discussion is probably a good way to act. And I think we need to think about behaviour as much as we do about rules. And sometimes you can't legislate rules, even soft rules like comply or explain. Those soft rules have to drive better behaviour. And what is it that owners of companies are most interested in? It's actually the sustained value in that company. We can have a debate, and I'm sure we will, perhaps not at this forum but elsewhere, as to what we mean by value. But that's ultimately why owners invest in companies, and value can't be created or protected by rigidly tick boxing against a set of rules. It can only be preserved and created through the right sort of behaviour that acknowledges that mistakes will be made but learns from those mistakes, that there is no 100% guarantee of success, but working patiently and in the correct way is the nearest you can get to a guarantee. And I think finally, as I bring my remarks to a close, that if there's an over-reliance on the compliance element of comply or explain, there is a real danger that the spirit of the rules, the spirit that was trying to be engendered by both the QCA code and the FRC's corporate governance code can be lost, and that actually could be a very dangerous outcome. And I think, you know, the plethora of advice, all well-meaning, actually is dangerous if that relationship between companies and their owners is damaged. So I will hand over to Sarah, who will make her introductory remarks. Thanks, Sarah.
Thanks. Thanks very much, Tim. There's been an awful lot of discussion about the shareholder spring this year, and I don't think that the shareholder spring is an entirely fair reflection of what's been going on. It's more like a thawing of a midwinter. Because let me tell you that by comparison with the UK, the US has seen far more debate on executive compensation than we've seen so far this year, with double-digit numbers of companies losing their say-on-pay vote. But I suppose for the media to actually get hold of issues and write about them, put them on the news at 10, corporate governance really has come an awful long way. The problem is it's come a long way, but there's still a great deal of misunderstanding about who the actors are in the process, what they do, what they should do, and what they don't do. So I'll kick off, because I'm a proxy advisor, and the first thing I'm going to say is we are not your owners. It may appear like we're your owners, but we're not. We're advisors. We advise your owners' fund managers. It gets very confusing, the number of actors in this process. We are information conduits, and you heard in the previous session before coffee about international accounting standards. Well, we have international governance standards, and we have disclosures in corporate governance which are as complicated as the accounting disclosures. Our job is to navigate through those 250-page 2-kilo annual reports and give to fund managers a potted view of what's actually going on in your organisation. Because Tim's absolutely right. Values matter, and values, we hope, will create the value in the long term. We've gone on record as saying, as we think executive remuneration is actually a window on the corporate soul. If you're getting the remuneration right, if you're aligning the pay with what you're actually doing in the business, you're going to get the right outcome. The great news is we've always found that the small cap companies are getting that better. The corporate governance is, as our analysts would often say, it's a bit all over the shop. Board diversity issues, board composition issues. I know that you struggle to find non-executive directors, but when it comes to the pay and rations side of things, sometimes we see the very best of practice coming out of the small cap companies. And as far as our work is concerned, we do go down to the AIM 100. So that puts us in a unique position in being able to survey the market. Your shareholder registers, though, are a very important part of your relationship with the wider market. And I know one of the frustrations that you all have is you don't know who your shareholders are in the main. It's very difficult to communicate with them. It is therefore very difficult for you to push back a different message directly to the shareholders. And luckily we have a regulator or quasi-regulator here who is actually working to improve that process so that you can actually know who your shareholders are. Shareholders who are put into pooled nominees, you're getting votes in every year, but you don't know who they're coming from or why. So please take advantage of the FRC's current consultation and complain bitterly if you're getting negative votes from shareholders, but you're not getting any explanation as to why people have voted the way they have. I know that fund managers don't have enough time to talk to all of the companies every year in which they invest, but that is not a good enough excuse, I think, for not actually explaining why you have actually done something. Hiding behind the skirts of a proxy advisor is also a pretty poor excuse for outreach as well. So small cap companies, I think, have a tremendous opportunity. I think that they've been the lifeblood of markets for a long time. We've always been a great fan of small cap companies. It's why we've followed the QCA guidelines with great interest, and we embed them in the research that we do. And we see a very open and democratic forum coming together to actually get the message across much, much better. It's not necessarily getting through to the fund managers, though, regrettably. And in our tracking of voting across the years, we do see that small cap companies struggle to get the kind of turnout that we know that large cap companies do, often down in the 30 or 40% level, rather than the 70% that a FTSE 100 company will tend to have. But it does mean that you're more likely to have a domestic shareholder base, which does make the outreach a little easier. So my bottom line is, remember that the proxy advisors are not the people that you should be responding to. If we're making mistakes about the way that we're interpreting your disclosures, you have every right to upbraid us, absolutely, and you have a right to reply. But any fund manager who is simply saying, well, I voted that way because so-and-so said I should, deserves a rocket, quite frankly, because they're the fiduciaries. They're the one who are charged with the investors to make the decisions. And I'm now going to hand over to the rest because I've been pretty opinionated there. And I'm really only an information messenger trying to put in place what guys like Threadneedle are actually doing. And it's actually really them who are forging that communication.
Thanks, James. Let's put you on the spot.
I mean, I guess as the investor, I'm sort of, I'd hope to think the pragmatist and the realist about, you know, obtaining the right outcome. At Threadneedle, I mean, we take corporate governance very seriously. We have a dedicated team of 3 people, but they don't sit sort of separate to us. And I think the key point about some of the changes to corporate governance are really sort of summed up in the stewardship code. And that has really changed our engagement with smaller companies quite considerably. I mean, we are in a very strong position as we've got, you know, a very large amount of money under management, and so we have the resource to be able to do that. But just to give you some stats, just to your point about, you know, fund managers not voting, this year to date, so we voted on 416 meetings, 53 within small cap, and we ended up engaging on 54 occasions. Within small cap, there's a much larger number. There were effectively 16 resolutions that we voted against management, three absentations and 13 votes against. But I think one of the interesting things is that within small caps, it's not so much remuneration that we have an issue with. And that's partly because, you know, we'd like to think that we're all ultimately on the same side, and ultimately our goal is to align all stakeholders with shareholders to basically get the key outcome, which is good corporate governance will lead to good risk-adjusted returns for our clients, and good management with the right skill set and incentives and strategy in place is basically a result of good corporate governance. And just on that engagement process, and I'll come on to maybe make a few comments about what's been said in Europe about issues to do with corporate governance, but the principle of comply or explain, I think, is very much a key approach. And proxy advisors can be very useful, but also sometimes they can be a little bit too prescriptive. Now, I mean, we understand with all that process that, you know, remuneration committee chairmen don't have a huge amount of resource, and also, you know, the advisors have only so much of a limited resource, but certainly it's the key starting point for a debate. And we've been very encouraged by our investee companies in terms of the responses to that active management and to the quality and depth of explanation that we've had as a result of that. I mean, in terms of the key issues that Europe's sort of flagging up, which is executive remuneration, diversity, non-executive directors and proxy advisors, and I think for us, and it comes out in our voting, especially in the small cap area, in terms of the independence, particularly of the audit committee and also the remuneration committee, and exactly what you mean by independence. There's certainly an issue in terms of the cost and also the scale of resource of small businesses in terms of having experienced non-executives and attracting them. And we certainly don't consider that necessarily a shareholding in the company is necessarily a route to independence. It's more behavioural based than just purely whether they're also shareholders. We see that as often in alignment with our interest, and we're very keen to invest in businesses that are owner managed and where there are still what would be considered non-independent individuals on the board. I think the key thing we would like to encourage is that a company has an ambition to obviously grow and to become a larger business, and that they've bought into the idea of increasing corporate governance standards as they progress and as they become a larger company. In terms of diversity, there's obviously been a lot written about diversity, and this is probably a more complex issue for smaller companies. I think it's key that we're very enthusiastic to see a larger pool gene pool of non-executive directors on board. And obviously there's a key balance between having strong financial reporting and accounting skill base as well as industry knowledge on boards. And just maybe finally on the proxy advisors, I mean, you know, I think they play a very useful role, and certainly when I worked in a much smaller business and you don't have the resource of having a large corporate governance team, they are the first port of call, and I think that is partly the issue. And I think, you know, the main point I would stress is that you know, that point of engagement and that shareholders, fund managers' time is restricted as everyone's is, but I think the majority are happy to engage if those issues are brought up and to have that discussion. And usually there is a reasonable resolution. And I think when we do vote against, I think the management often understand our reasons for voting against and recognise that issue. And in a way it's a flag, and certainly when we abstain it's a flag to the fact that, you know, we're looking for change in the future, but recognise that in a small business there are lots of issues going on, and that has to be a progressive process.
Thank you very much, James. And over to Stephen Haddrill, guardian of the two codes in the UK.
Well, thank you, Tim. And can I just thank the QCA for its great work on corporate governance. We very much admire what you've done over the years, and I know that's been under your leadership. The FRC exists to promote high standards of corporate governance and corporate reporting. That's our mission. And I just want to reflect for a second on the fact that we have those two missions, corporate governance and corporate reporting, because we actually see those as quite integral to each other and linked. Good governance is there to promote good behaviour, as you were talking about. I always jib slightly at this word behaviour. It takes me back to sort of primary school, but nevertheless, I can't think of a better one, so I'll continue to use it. And so is good reporting. I mean, we do feel that the need to report, the requirement to report, should make people honest and true in thinking about their work during the course of the year, so that they can report and report a good story when they get to the end of the year. And that's why actually some of our reporting requirements, yes, are captured in the accounting standards and so on, but they're also very much captured in the Corporate Governance Code, and we're consulting at the moment on changes to narrative reporting. We're looking for a better quality report from the Audit Committee. We're looking for better quality reports on risk, what's actually gone on the Audit Committee, what's keeping them awake at night. And crucially, we're looking for the directors to sign off, the board as a whole, the directors, to sign off on the whole report as being balanced, fair and understandable. And that's partly because we do really want to get away from this idea, as Sarah was saying over the coffee break, of the report as a kind of brochure. This is something we want the board to take extremely seriously. Now, this session is, however, about engagement. The Corporate Governance Code and the Stewardship Code that go alongside it are based upon principles. There are a lot of provisions that underpin them, but we're not writing detailed rules. And that's because we do not believe that a code that is prescriptive will do anything other than stifle enterprise and effectively weaken governance. Because actually, if you write rules and you just bring the lawyers in to tell you how to obey the rules, then the board is not doing what it needs to do, which is to consider very carefully how to sign up to the principles and what they mean to the company. And that's why the overarching principle of comply or explain, as you've mentioned, Tim, is so important to us. We feel that in the UK, that comply or explain thrust has got the UK further ahead than many of our continental cousins. We have seen the separation of chairman and chief executive rather faster here than in some other markets. We have seen the growth of independent audit committees faster here than in some other markets and so on. Lots of reasons for that, but we think that the ability of companies to embrace the aspirational nature of the combined code, of the Corporate Governance Code, kind of in their own time, helps us to set a higher level of aspiration and give people time to come along with it. Now, on the Stewardship Code, as you said, we are seeking to promote shareholder activism and engagement. We reviewed the effectiveness of the code at the end of last year. We've got over 250 signatories to the code, but that's an input measure. The output side, the outcome side, is much harder to measure. We are encouraged, I have to say, by what we've seen over the last few months with an increasing level of shareholder engagement. I was interested in what Sarah was saying about the level of activity in the US, because I think to some extent we've felt, listening to UK shareholders, that they have found their American cousins being more active has given them some encouragement as well. We're encouraged that shareholders have been quite targeted in the votes they've made against the board. I think on remuneration, the general level of, the average level of voting has, from I think Sarah's own figures, has been rather typical this year compared to previous years. But there have obviously been some particular targeting of particular companies where shareholders have real anxieties. And I think that what that says to us is that we shouldn't run away with the idea that there's a political element to this. This is being driven by concerns about value creation and whether the shareholders are getting a fair slice of the pot. Tim mentioned that it's not necessarily a good thing that shareholders are having a row with their boards in public, and that isn't the objective of the Stewardship Code to any extent. The objective of the Stewardship Code is to promote good engagement behind the scenes. But what we've always been conscious of is that takes two to arrange that effective engagement. It actually takes both sides. quite often we hear from companies that investors are not engaging with them as much as the other way round. What we want to see is that good quality engagement. But I guess you have to recognise that sometimes the listening only happens after the row has taken place. So, you know, I would rather not have a great outbreak of rows every year. I'd rather that listening now took off very strongly. But perhaps we don't regret a few, to quote Sarah, as we emerge from the hardness of winter. A recent IMA survey of investors has also provided some positive data about the development of stewardship. It shows there's more focus on collective engagement, a general awareness of the need for governance and investment decision-making also to be more joined up. I mean, we constantly hear from companies that they don't like it when they're hearing one thing from a portfolio manager and one thing from the governance team. And it looks as if that may be getting a bit better, but maybe you have different views on that and will tell us what you think about that. There's always a tendency, obviously, to talk about, to focus on the asset managers, the fund managers. At the FRC, we're also concerned to engage with the pension funds themselves, the insurance companies, charities, anyone who are the ultimate beneficiaries of the money. And I think that's very important, and we're delighted that the NAPF has been a long-standing supporter of the Stewardship Code, and the ABI over the last year has also been putting more emphasis on the role that life companies can play as owners alongside their role as fund managers. Now, Tim, you kindly pointed out the voluminous number of consultations that we've been issuing. It's perhaps inappropriate to apologise for something that we have done, and we do actually want people's views on, and nevertheless I do recognise the impact that makes. Parliament only 2 nights ago voted to enable us to restructure our own organisation into 2 divisions, one focused on codes and standards, one focused on the conduct and supervision of the audit market. One of the reasons we're doing that is to make sure that we are genuinely strategic when we seek to make an intervention or seek to make a change. And I hope that that flows through into our work in the future. It is very important to us that we don't drive everyone spare by consulting again and again on minutiae, but we are actually focused on the most strategic issues, and that's what we're seeking to do. The government has asked the FRC to consider making further changes to the code, so there's potential for a bit more consultation coming here, on the question of remuneration. It asked us to look at what the code should say on clawback. It has asked us to also look at what the code should say on executive directors sitting on as non-executives on the remuneration committees of other companies, not their own, on which they're executives. And it's also asked us more recently, very recently, to consult on how the code can be used instead of having a binding vote, as was earlier proposed. Now, we're not going to rush into consultation, you'll be pleased to know. We feel that we know the government is going to be bringing forward legislation in this area. We want to see how that comes out of Parliament. We want to see how it beds in. So we will wait for that to go through before we consult on changes to the code on the back of changes to legislation. But ultimately, I think that there's a key theme that's coming through today, which is that, yes, corporate governance is about good behaviour in companies, it is about shareholder value, but none of that's going to work unless we take seriously this opportunity that comes with Comply or Explain, and we have good quality explanations and we have good quality engagement from the investment community.
Thank you very much, Stephen. I'd like to open the discussion up to you, the audience. So is there anyone who has a question? I've got one, I've got several here. Perhaps Edward here, then the gentleman there on the right, and then the gentleman over there. And perhaps if we take 3 questions and then we'll respond to them collectively.
Edward Beale, I'm Chief Executive of Citigroup. In my view, it's vital that investors trust directors who are the investors' agents responsible for managing the investor's company. poor corporate governance, including remuneration issues, has damaged this trust, as has poor engagement by investors. The FRC has a role through its focus on both governance and reporting, which relates directly to this issue of trust. I think the whole reason for existence of the FRC is about building this trust. We have a UK corporate governance code which is rightly not rules-based and is rightly principles-based. But to me, in addressing principles, we're actually addressing the second level down, and we ought to be addressing the top level, the trust. And my question to the panel is, should the FRC be challenging boards to address directly what they're doing in order to build trust, and reducing the focus on principles and provisions?
Thanks, Edward. Should we just take the other two questions and then we'll answer them all together? There's one just behind you there, Jack, and then one over there.
Colin Glass. I was glad that Tim mentioned about the code of behaviour, which is to create and protect value on behalf of shareholders, and the board has to make the judgment as to what is best. I'm involved as a non-exec on 3 small AIM companies, and effectively myself and my colleagues who I'm privileged to sort of be dealing with, I don't think you can buy our independence or buy off our independence. It's all about integrity, and I would like to think that that happens with the directors of most companies. So bringing that on to the other important question of remuneration and how that remuneration works throughout, and I've helped these companies since their formation in most cases, and seen them grow from very small beginnings to flotation on AIM. It's been impossible to pay myself or my colleagues an economic rate for what we are doing, and in the past we have had share options. Now I know that all this question of independence, somewhere down the line share options for non-execs is not looked at very favourably, but I feel very strongly that it aligns our interest with all the shareholders, obviously, to create reward. It does not affect independence, because I would like to think that myself and my colleagues are above all that, and I think it is an important way of not getting the balance wrong in the total remuneration package vis-à-vis the executives. We do take corporate governance very seriously in all the companies, but they are small companies and we have to be practical. But I just wondered what the panel's view on share options for non-execs in that context is.
Thank you very much. And then there's one over here, and then we'll answer them all.
Alan Newman. Having just chaired the session on financial reporting, I'd like to just try and join a couple of dots together here. I mean, it's fairly evidently in the last session we discussed what I can best summarise as the issue of proportionality as far as small and medium, small cap companies are concerned in relation to financial reporting. And you know, my own view, I guess, on balance, probably was tilted more towards Andy Bruff's than Patricia's, in terms of the feeling that we have too much rigidity around the requirements as far as small caps are concerned on reporting. I wonder, particularly, Stephen, if you can comment on how the Financial Reporting Council is looking at how it might take the principles of comply and explain that quite rightly and admirably are being followed for the code in relation. How can you help us to perhaps persuade IASB and others that same principle should apply to some of the financial reporting issues? In other words, you know, one has more scope to judge whether or not it's appropriate for our size of companies to be following these rules to the letter. Well, not so much the rules to the letter, but whether or not they're relevant. And I'm not sure what the FRC's position is on that.
Thank you very much. I think I'll perhaps ask Stephen to respond to questions 1 and 3 first, and if others on the panel wish to to chip in. So really, should there be a high-level focus on trust between boards and their investors from the FRC, and should there be some comply or explain principles in relation to reporting?
Edward, thank you for that question. I think it's a very good reminder of what this is all about. Because ultimately, what the FRC is interested in from a general economic perspective is about generating confidence in the capital market. And that, of course, does depend. That notion of confidence is perhaps another way of expressing what you're saying about trust. I think it's absolutely right that the directors should be sitting around the boardroom table and asking themselves that question. How do we communicate? How do we generate that sense of trust, and justifiable trust, of course, amongst our shareholder community, and indeed, perhaps more broadly, amongst the public at large in certain companies? I believe that some of the principles in the Corporate Governance Code are the kinds of things, and also the principles of good reporting are the kinds of things you would then do in order to build that trust. So I don't want to sort of feel that they're in some way irrelevant. I think they're a contribution to it, but I think that what you've put on the table is an excellent question for the board to be debating on an annual basis. So I'll take that away. I've got a lot of sympathy with this idea that particularly at the lower end of the smaller end of the market, be careful what adjectives I choose here, that we should have more proportionality in reporting. It does seem to me that that's something that is a growing debate. It's a growing debate in Europe, although we are often rather at odds with our counterparts in France. They have been putting that on the table as something that, you know, the smaller end of the listed market should be allowed more flexibility. I think it's a good thing to debate. Whether there are essentially there are two approaches. One approach is to simplify the accounting standards in relation to that market, and the other approach is to allow, as you say, some kind of comply or explain mechanism. I think our approach has been rather the former rather than the latter, but I think that's something that is worth considering. And it depends really on whether you think that there should be as much comparability as possible. How important that is to investors, I don't know whether investors would like to comment on that, and whether there is actually a sufficient degree of trust to allow that to happen. So, but I agree with the objective. I'm not quite sure whether comply or explain is the right way through yet.
Thank you. And I don't know if either of my panellists want to comment on either of those, and then I'll ask you to comment on options for non-executives.
I'm always surprised when people think that they need permission in the form of a guideline or a rule to do something which is basically the right thing. If directors think that society as a whole doesn't believe in industry anymore and they need to communicate better, there's nothing stopping you doing it. Use the annual report to communicate that message that integrity is at the heart of your business. I'm not sure that we need a rule to actually do that. But I think you're right that trust has been damaged, and I'm not sure that we've really had a sufficient truth and reconciliation between society and high finance. And people, as some of you know, every year we do this survey with MM&K on executive pay. And they somehow think that I've crossed sides and I'm now apologist for high pay in supporting a remuneration consultant. And I said, well, actually, I think it's very important to get across the message that small caps are not the FTSE 30. They do things differently, and often the quality of the reporting is actually much better. Because they really are telling their story rather than just sticking with compliance tick box, include this, include that, include the other. There's just a much more personal touch in it. So if you as directors think trust has been undermined and you think you've got a part to play in rebuilding it, go for it. Use your annual report, use your website, tell shareholders your story. I think that's absolutely right. Comparability that IFRS brings, I remain to be convinced in its execution for small caps. I'm still watching and waiting. An awful lot of my clients are IFRS skeptics with a capital S, and I'll just leave it at that.
I mean, just on the trust point, I mean, I totally agree, and I think in many cases, you know, trust has obviously been tested, and I think, you know, that comes with time, and I guess that the point of short-termism, and we would like to think that we want to build relationships with management teams and with companies over the long term, and I think then that becomes a lot more easier in terms of having that trust with the board and the non-executives to actually work with outside of a set of principle-based rules, and it goes back to becoming a, you know, a longer-term investor, and that's our role to, you know, convince our clients that that's also what they want. So they want to be long-term investors rather than looking at the short term in terms of returns from that we can generate from them.
Thank you. And on to the thorny issue of options for non-executives. You will be aware, I'm sure, that the QCA has recently published its guide for remuneration committees, and it was the most controversial guide when in the production stage in terms of the difference of views and coming to a broad consensus, and options for non-executives was one of those big debating points in the production of the guide. I'll ask James and Sarah to comment first, and then perhaps I'll chip in with perhaps both the personal view and what the QCA ultimately said in its guide.
It's your turn to go.
Okay. Well, I completely agree with your comments and totally understand, and would also want to have non-executives who are very experienced and recognise that they dedicate a huge amount of time to small companies, and takes a huge amount of effort, probably an awful lot more than it does with larger companies. And we support and are happy with NEDs being remunerated in the form of basic fees that are cash or shares. But prior to that, we recognise that pre-flotation, these companies are even in an earlier stage of development, and are happy to have seen that non-executives have been awarded share options. But we would want that to end once you've come to the quoted market, and really that's a point of which, you know, you are going through that evolutionary process, and if the company is not really at a size or a level of profitability or its ability to raise capital to move to a share-based payment or actual salaries, then it may well be a case that it's not appropriate for that company to list on the AIM market.
Thanks, James. Sarah, do you have anything to?
The overwhelming majority of my clients would echo that, which is, yes, non-executive directors should have a meaningful ownership in shares, but options wouldn't be the route that they would choose. That said, it raises a very interesting question about the role of institutional best practice guidelines and how frequently they are revisited, and whether they're entirely appropriate for all sizes of company. And one of the problems, often things like institutional guidelines on dilution, for example. 10% of Barclays or WPP is a very large amount of capital to be set aside for variable pay. But in a small cap company, 10% may well not be enough. And so I do applaud the QCA for really having a go at trying to create a new and dynamic set of principles on remuneration for small cap companies. And I think this is very welcome, because we do need to chip away at some of these guidelines which have just become stuck because they were developed maybe 15, 20 years ago, and that are not revisited frequently enough.
Thanks, Sarah. From a personal and certainly from a Hermes standpoint, I think the views that have been expressed accord pretty similarly with mine. The point that the QCA guide strove to make was to emphasise the point of explain. It is controversial, so if the board in its judgment decides that it is going to award options to its non-executives, the important thing to do is to discuss the reasons for that in advance with your shareholders, and explain and engage with them the reasons for so doing. And even ultimately, if some or all of the shareholder base disagree with what you are doing, I think they would absolutely welcome the fact that if you talk to your larger and your more engaged shareholders, that conversation has taken place, and it also gives the basis for a conversation on wider issues. And one of the points that I think I would like to make, abusing briefly my position as chair, is that so much of the debate is about remuneration and not about other matters, and the engagement should be based around long-term strategy, risk management, those value drivers, and governance as a tool to achieve those value drivers. And sadly, too much of the debate, possibly even here today, has been on remuneration. So I do think it's incumbent on investors to talk about other things, and if necessary, vote on other matters in an adverse way other than remuneration. I know Tim wants us to wrap up at 10:02. I know my watch is a minute or two fast, so we've got time for one last question that we will answer very briefly if there is anyone who wants one last question. Thank you. Just here.
So getting back to the idea of small companies, we're quite fortunate that we can have shareholders come and meet us at our AGM and actually discuss things with management, because we don't have too many shareholders. I think it's like 10 or 20 out of our 2,000 private investors. And perhaps rather than concentrate too much on the documentation in the annual report, just making it easier for people to meet the management in a small company might do a lot for helping trust.
So it was an observation rather than a question. Yeah. Yeah.
How much should it be just printed documents, and how much should it be more of a relationship with the shareholders?
From my part, I think the relationship is invaluable. I think engagement one gets a sense of the company far more from the written page, from meeting its directors. I think it's complementary, the written word, because the better the written word, the higher quality direct dialogue one can have with the company. If the reporting is poor, then the conversation is trying to understand the company, whereas if the reporting is good, it can lead to a better in-depth dialogue with the company. So that would be my view. Does anyone else have anything to?
Well, I agree with you entirely, and I think it's important that dialogue happens, the engagement happens before trouble arises. It's too late then, it seems to me.
Yeah, that's a very important point. James?
Yeah, no, I'd agree, and we're trying to meet more non-executive chairmen for that very reason. And in the past, I think it would be fair to blame us for some of our first conversations with non-execs are when things are going wrong, rather than from a positive point of trying to help to develop strategy.
I think AGMs are a very important forum. The difficulty is that if everybody has their meeting in May, you can't go to them all. And this is a problem of accounting. We are absolutely convinced that there's no need for everybody to have a 31st of December year end. More people should be taking advantage of May and June for holding their AGMs and reporting, and I'm really pleased to see people. Professor Kay's work on short-termism, I think, is going to be a very important contributor to the debate. Why the stock market feels it's important to have its reporting set as a priority over share ownership reporting. A typical portfolio manager, well diversified, during the worst part of proxy season will be doing 200 meetings a week. They can't possibly turn up to those meetings, and I think that is a great shame. And retail shareholders who own your shares through other products can't come to the meeting either, because their ownership has been lost, they are disenfranchised, and that's a great shame.
Okay. Thanks, Sarah. I'd like to thank you, the audience, and the three panellists for what's been a very useful and interesting session. So thank you.